Hey everybody, Kyle Knott here, not your average financial guy, coming to you with another episode in the four-step process of velocity banking. Today we're going to talk about HELOC, home equity line of credit. This is your ultimate debt tool, and this is where we're going to make the magic happen. Let's jump in here. So, come on. Here's what we're going to do. Let me get my face out of the way. How it works. So basically, figure out what's your home worth. So you can go on Zillow, Realtor.com, whatever. You can get your Zestimate. You have an average. You kind of know what your house is worth, right? You can talk to a realtor if you want. You can get what's called a BPO, a broker's price opinion. You might have to pay a couple bucks for that, but if you know a realtor, they can usually do that pretty simply. But that number one is figure out what your home is worth, and then the second number two here is let's take that times 0.8. So what that's doing is taking an 80% loan to value, or LTV. Fancy words that the bank likes to use, but most of the times you can get a HELOC for 80, sometimes all the way up to 90% of your home's value. So we're just being conservative here, and we're looking at 80%. So take whatever your house is worth, and then take that number times 0.8, and then that'll give you that LTV, or loan to value equity, that you can possibly get a HELOC for. And then number three here, how much do you owe on your house? So if I think I got an example coming up here next, but we're gonna look at how much you owe on your house. So look up at your mortgage statement, and see what that is, how much do you owe on it. And then number four, we're going to take 80% of the home value, which is number two, and then we're going to subtract the amount owed, which is number three, and that will give you what you can get for a HELOC and availability from the bank. So here's an example here. Let's say that your house is worth $300,000, and you take that number times 0.8 is $240,000. So that's the most that the bank will let you borrow against your house. So now you've got to subtract, how much do you owe on your house. So in this example, this person owed about $150,000 on their house. So then you take the 240, number two, minus number three, the 150. So 240 minus 150 equals $90,000. So in this example, this person would have a HELOC availability of up to $90,000 that they could possibly get their hands on and use if they've got some good credit. If and when you go into the bank and you try to get a HELOC, most bankers are going to tell you that you want a home equity loan. You do not. A home equity loan is a lot better for the bank than it is for you. So when you go into the bank, tell them that you're looking for a home equity line of credit. We need this to be a revolving line of credit, and because what we're going to do with the velocity banking principle is we're going to be dumping our paychecks in there as soon as we get paid. As soon as any money comes into our system, we're putting it right into against the line of credit to knock that principal down as fast as possible. As the expenses come out throughout the month, then it's going to go back out. We're actually taking a loan for those expenses, but it's better in the long run because the way the home equity line of credit interest is calculated, it's an average of the entire month. So if you can take your paycheck, of whatever you make, say you can throw $1,000 in there and knock that down by $1,000, and then slowly, you have other expenses come out. You get your next paycheck, you knock it down by another $1,000, and it goes back up by a little bit. So that's what we're trying to do. We need this to be a revolving line of credit. We do not want a loan. And a lot of banks will tell you that a home equity loan, well, the interest rate is lower than a home equity line of credit. Don't care. The interest rate doesn't really matter that much. We need this to be a revolving line of credit for this process to work. So tell them no politely, and if they keep pushing every bank is different. Some banks don't want to get into the home equity line of credit business. A bank that I do a lot of business with, I talked to them about a home equity line of credit, and it's just not very good. So I talked to another bank. So we've got a couple more things we're looking for here as we go look for a HELOC. And just because the first bank you go to doesn't fit the mold, keep looking. Go to a different bank. I personally like smaller community banks. You build a little bit of a relationship with a personal banker. You can call right to them, and they know you. You can sit and you can talk to them face to face in your local community. And to me, it's just been a lot easier than dealing with the big U.S. banks, Wells Fargo, whatever. Years ago, I had a payment that somehow didn't get pulled, and I tried to call and talk to somebody, and I'm talking to some call center in India, and it was just a pain in the ass to try to get through to anybody to actually get an answer. Where if you're with a small local bank, maybe they got 4 or 5 branches, whatever, you can go right down to the branch and you can talk to your person that and they will get to the bottom of it. So that's the way I like it, but you can do however you want. So some of your HELOC must-haves here is you have to have check writing ability, or with no or a high limit of transactions per month. So what we're doing, like I said, is we're going to take our income and we're going to put it in towards the HELOC balance. And as our expenses come out, what we want to do is we want to control ourselves with the credit cards and try to put everything onto a credit card that you possibly can, but at the end of the month, know that you have to pay that credit card off in full. We don't want to put any more expenses on a credit card if we're not paying it off in full. That's taking us backwards. So ideally, we can put our income in as soon as we get it, and then we have maybe one credit card bill comes out. I can't put my mortgage. They won't take it a Crown credit card. So that's one thing that does come out of my checking account. So that gets you down to the online banking access, which we'll get to. But you kind of have to shift back and forth a little bit. So there is a little bit of work that you have to do with this, but it's super minimal. 5 minutes a week is more than enough. You just log into your online account and take care of this stuff. So number 2 here, the ability to make multiple principal payments each month. So unless you get paid once a month, that won't matter. But if you're like most everyone else probably gets paid either bi-weekly or bi-monthly. I get paid weekly at my regular job, so every week it's usually like Wednesday, my paycheck gets put into, and this gets put into my checking account, and then every Wednesday I physically log in and I transfer my entire paycheck over to my HELOC balance. So I knock that down by my entire paycheck. Another thing we're looking for is the interest-only draw period of at least 5 years. The more the better. I have heard of interest-only draw periods that will go 30 years. I think those are few and far between, but I will try to track that down and maybe get a link out for you guys. But I have also seen banks that they only do 1 year interest-only draw period, and that's fine, but we need a little bit more time to make this work. Like I said, with Velocity Banking, in most cases between 5 and 7 years, you can be completely out of debt. Even if you want to pay off your home, maybe it'll take a couple more years, depending on your circumstances. But even if you want to attack your house, which I'm going to make another video, which I don't really agree with, that may not be the best way to go, but it's you can do whatever you want. Some people just hate debt and want out of it altogether, so that's fine. Go for it. This will work. So with that, we need a draw period of at least 5 years. The more the better. If they have a 10-year draw period, that's pretty good. We can make a lot happen in 10 years. And what that means is the interest-only draw period. So, if it's 10 years, you have 10 years that you can draw against this line of credit. What do we say? This example was $90,000, I think. So say we're going to take out $10,000 and we're going to pay off our car loan. And we're going to use our, the Velocity Banking principles, and we're going to knock that debt down. And what we're going to do then with that is then you only have to pay interest. So what we're doing is every time we put our entire paycheck in, is we're knocking that principal down. At the end of whatever that draw period is, say it's 10 years. At that point, they're like, okay, you can't take any more out, which means you can't pay your expenses from your line of credit. You now have to get into a program where it pays that line of credit off. So if we can kick this can down 5 or ideally 10 years, we can get a lot done. At the end of 10 years, if you've got a balance on your home equity line of credit, and we've been using this system, hopefully by that time you've proven to the banks that you're using this tool responsibly. they're just going to give you they'll renew it. They'll probably charge you another $250 or whatever, some fees to renew it, and they'll just roll you into another 10-year draw period. Now, if you abuse this, and if you got $90,000 of home equity, and you just take that right up to the very end, and you're making your minimum payments at the end of your draw period, they're going to want to see you making some headway of paying that back. So it's all about your behavior, but if you follow the velocity banking principles that we talk about here, you'll have no problem. I have never had a problem at the end of that draw period just renewing it. And then, like I said too, the last thing here is online banking access. So that just makes it really simple. But like if you have a local bank, you can call down there, and you can talk to a personal banker, and you can make the transactions that way. With everything online now, it's just super simple. You get on, it's a couple clicks, transfer your money from to and from your checking account into your HELOC or vice versa. Like I said, I got I think it's my car payment. My car payment will not get paid from my HELOC. And now my HELOC has check writing ability. I forgot to say something about that. I have actual physical checks. It has a routing number. It has an account number. So anytime anyone needs any kind of a ACH transfer or anything like that, you've got those numbers. It literally is the same as a checking account. There's really not a lot of difference, but for some reason, like I said, my card payment, it won't go. So I had to take that out of my checking account. So I just make sure, when that comes out, whatever, I think it's the 15th of the month, I just make sure that I've got enough in my checking account to cover that payment. Otherwise, every single cent that I've got goes into that home equity line of credit and knocks that principal down as fast as possible. Remember, the lower the principal, the lower you're paying, the lower interest you're paying. Even if my right now my HELOC is at 9%, and I'm okay with that. I try to knock that down as fast as I possibly can, and let's get that as close to zero as we can, and then let's go ahead and grab something else, pay it off, and hopefully the way that we're talking here is every time you're making a HELOC payment, that interest payment that you're making should be less than the minimum payment you were making on your other debt. So we'll dive more into that later, but wanted to touch on HELOCs a little bit here. And remember, you can also do this with a PLOC, which is a personal line of credit. Kind of the same thing, but with that, the interest rates are usually a little bit higher. But if you own your own home and you've got some equity, like we had back here, so if you've got some equity, like this is showing, like this example, go through these 4 steps, and if you've got equity available in your house, this is the way to go. Probably 90% of the time, this is probably your best route. So if not, there are other ways you can do it. Like I said, a personal line of credit, or you can even do it with a credit card. If you got good credit and you can get like a 0% financing card for a year and a half, we can do a lot of damage with that in a year and a half. So that could be your debt tool as well. But I want to dedicate this video to the home equity line of credit. And I hope this helps. Please leave me some comments. Let me know how I can help you guys. And let's knock this debt out.